Hey everyone, and welcome to Satoshi Finance. Today we will be exploring mutual funds, a fundamental building block of investment portfolios. Whether you're a seasoned investor seeking to diversify your holdings, or a newcomer eager to learn about wealth-building opportunities, you've come to the right place. In this video, we'll unravel the mysteries of mutual funds, uncovering their significance in the world of finance and their potential to help you achieve your financial aspirations. So sit back, relax, and join us on this enlightening journey into the world of mutual funds. In the realm of investment, mutual funds stand as a cornerstone for both seasoned investors and newcomers alike. At its core, a mutual fund is a professionally managed investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. This collective investment structure allows individuals to access a wide range of investment opportunities while benefiting from the expertise of professional fund managers. With mutual funds, investors can achieve diversification across various asset classes and sectors, mitigating risk and potentially enhancing returns over the long term. The importance of mutual funds in investment portfolios cannot be overstated. For many individuals, mutual funds serve as a convenient and accessible way to participate in the financial markets without the need for extensive knowledge or expertise. By investing in mutual funds, individuals can gain exposure to a diversified portfolio of assets, helping them spread risk and achieve their financial goals. Whether it's saving for retirement, funding a child's education, or building wealth over time, mutual funds offer flexibility, liquidity, and the potential for long-term capital appreciation. As we delve deeper into the world of mutual funds, we uncover the myriad benefits and considerations that make them a valuable tool for investors seeking to grow and preserve their wealth. Mutual funds represent a collective investment vehicle that brings together funds from multiple investors to create a diversified portfolio managed by professional fund managers. This pooling of funds allows individual investors to access a wide range of investment opportunities that may otherwise be unavailable to them individually. Fund managers leverage their expertise to make strategic investment decisions aimed at achieving the fund's stated objectives, whether it be capital appreciation, income generation, or a combination of both. One of the key advantages of mutual funds is their ability to offer diversification across various asset classes and sectors, helping to spread risk and potentially enhance returns over time. Within mutual funds, investors can find a plethora of investment options, catering to different risk profiles and investment objectives. These funds typically invest in a variety of assets, including stocks, bonds, or a combination of both. Equity funds primarily invest in stocks of companies, offering the potential for capital growth over the long term. Bond funds, on the other hand, focus on fixed income securities such as government bonds, corporate bonds, and municipal bonds, aiming to generate regular income through interest payments. Balanced funds, also known as asset allocation funds, invest in a mix of stocks and bonds to provide a balanced approach to risk and return. By understanding the types of assets held within mutual funds, investors can choose funds that align with their investment goals and risk tolerance, thereby optimizing their investment portfolios for long-term success. Mutual funds come in various shapes and sizes, each tailored to meet different investment objectives and risk preferences. Equity funds, also known as stock funds, focus primarily on investing in stocks of publicly traded companies. These funds offer investors the opportunity for capital appreciation over the long term, as they aim to benefit from the growth potential of the companies in which they invest. Equity funds may further categorize into subtypes such as large cap, mid cap, small cap, or sector-specific funds, providing investors with the flexibility to target specific market segments or industries based on their investment goals. On the other hand, bond funds primarily invest in fixed income securities, including government bonds, corporate bonds, and municipal bonds. Bond funds aim to generate regular income for investors through interest payments, while also providing relative stability to investment portfolios. Investors seeking income generation and capital preservation often turn to bond funds, which offer predictable cash flows and lower volatility compared to equity funds. Additionally, balanced funds, also known as asset allocation funds, offer a mix of both stocks and bonds within a single portfolio. These funds aim to strike a balance between growth and income, providing diversification and risk management benefits to investors. Finally, specialty funds and index funds offer unique investment strategies, such as investing in specific industries, regions, or asset classes. Index funds, in particular, aim to replicate the performance of a market index, such as the S&P 500, by investing in the same securities in the same proportions. These funds typically offer low fees and can be an excellent option for investors seeking broad market exposure at a lower cost. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Mutual funds operate on a simple yet effective structure that allows individual investors to pool their money together, creating a diversified investment portfolio managed by professional fund managers. Investors purchase units or shares of the mutual fund, with each unit representing a proportional ownership stake in the fund's underlying assets. The value of these units is determined by the net asset value, NAV, of the fund, which is calculated by dividing the total value of the fund's assets by the total number of units outstanding. The NAV fluctuates daily based on changes in the market value of the fund's holdings, providing investors with an accurate reflection of the fund's performance. Understanding how mutual funds work involves grasping the fund's objectives and investment strategies. Each mutual fund is designed with specific investment goals in mind, whether it be capital appreciation, income generation, or a combination of both. Fund managers develop investment strategies aligned with these objectives, selecting securities and asset allocation strategies to achieve the desired outcomes. It's crucial for investors to review the fund's prospectus, a legal document that provides detailed information about the fund's investment objectives, strategies, risks, fees, and historical performance. By studying the prospectus, investors can gain insights into the fund's investment approach, assess its suitability for their investment goals and risk tolerance, and make informed investment decisions. Investing in mutual funds offers a multitude of benefits that appeal to both novice and experienced investors alike. One of the primary advantages is the built-in diversification provided by mutual funds. By pooling funds from numerous investors and investing in a wide range of securities, mutual funds spread risk across different asset classes, industries, and geographic regions. This diversification helps mitigate the impact of individual security or sector-specific downturns on the overall portfolio, thus reducing overall investment risk. Additionally, mutual funds are managed by experienced professionals who conduct thorough research and analysis to make informed investment decisions on behalf of investors. This professional management expertise can be particularly beneficial for investors who lack the time, resources, or expertise to manage their investments actively. However, despite their numerous benefits, mutual funds also come with inherent risks that investors should be aware of. One of the primary risks associated with mutual funds is market risk, stemming from fluctuations in the value of the securities held within the fund's portfolio. Market risk exposes investors to the possibility of experiencing losses due to adverse movements in stock or bond prices. Additionally, mutual funds may also be subject to management risk, arising from the fund manager's investment decisions or strategy execution. Poor investment decisions, unexpected market events, or changes in economic conditions can impact the fund's performance and, consequently, the returns received by investors. Furthermore, mutual funds may also carry fees and expenses, including management fees, administrative costs, and sales charges, which can erode investment returns over time. Therefore, while mutual funds offer numerous benefits, investors should carefully consider the associated risks and fees before investing and ensure that the fund aligns with their investment objectives and risk tolerance. Investing in mutual funds is a straightforward process that can be accomplished with relative ease. The first step is to open a mutual fund account, which can typically be done through a brokerage firm, financial advisor, or directly with the mutual fund company. Investors will need to provide personal information, such as their name, address, social security number, and financial details, to complete the account opening process. Once the account is established, investors can then begin selecting mutual funds to invest in based on their financial goals, risk tolerance, and investment preferences. Choosing the right mutual fund is a critical decision that requires careful consideration of various factors. Investors should assess their investment objectives, time horizon, and risk tolerance to determine which types of mutual funds align best with their needs. Additionally, investors should evaluate the fund's investment strategy, performance history, and fees to ensure they are comfortable with the fund's approach and potential returns. Dollar cost averaging and systematic investment plans are popular investment strategies that allow investors to regularly contribute a fixed amount of money into mutual funds at predetermined intervals. These strategies help investors mitigate the impact of market volatility by spreading out their investments over time, potentially reducing the risk of investing a large sum of money at an inopportune time. By following these steps and implementing sound investment strategies, investors can effectively build and manage a diversified mutual fund portfolio tailored to their financial goals and objectives. Understanding the fees and expenses associated with mutual funds is crucial for investors to make informed decisions and maximize their investment returns. Mutual funds may charge various fees, including front-end loads, back-end loads, and no-load fees. Front-end loads are sales charges applied at the time of purchase, deducted from the initial investment amount. Back-end loads, also known as deferred sales charges, are fees incurred when investors sell their mutual fund shares within a specified period after purchase. On the other hand, no-load funds do not charge sales commissions, allowing investors to invest their entire contribution into the fund without deductions. In addition to sales charges, mutual funds also impose annual operating expenses and management fees to cover administrative costs and compensate fund managers. These expenses are typically expressed as a percentage of the fund's assets under management, AUM, and are deducted from the fund's NAV, reducing the returns received by investors. It's essential for investors to carefully review and understand the fees associated with mutual funds before investing, as these fees can significantly impact overall investment returns over time. By selecting funds with lower expense ratios and avoiding unnecessary sales charges, investors can minimize the impact of fees on their investment performance and optimize their investment outcomes. Therefore, conducting thorough research and comparing fees across different mutual fund options is essential for investors to make informed investment decisions and maximize their investment returns over the long term. Performance metrics play a critical role in evaluating the success and suitability of mutual funds for investors. Among the key performance metrics used to assess mutual fund performance are return on investment, ROI, standard deviation, and the Sharpe ratio. Return on investment measures the profitability of an investment over a specific period, indicating the percentage increase or decrease in the value of the investment relative to its initial cost. This metric provides investors with insights into the fund's historical performance and its ability to generate returns for investors. Standard deviation measures the volatility or risk associated with an investment, reflecting the degree of fluctuation in the fund's returns over time. A higher standard deviation indicates greater volatility and potential investment risk, while a lower standard deviation suggests more stable returns. The Sharpe ratio, named after Nobel laureate William F. Sharpe, is a risk-adjusted measure that evaluates the risk-adjusted returns of an investment relative to its volatility. It provides investors with a standardized measure of risk-adjusted performance, taking into account both the investment's return and its risk level. A higher Sharpe ratio indicates superior risk-adjusted returns, reflecting a more efficient use of risk to achieve investment returns. When interpreting historical performance data, investors should consider various factors, including the fund's investment objectives, risk tolerance, and market conditions. It's essential to analyze performance metrics in conjunction with other qualitative and quantitative factors to gain a comprehensive understanding of a mutual fund's performance and suitability for investment. By utilizing performance metrics effectively, investors can make informed decisions, evaluate investment options, and construct a well-diversified investment portfolio aligned with their financial goals and risk preferences. Understanding the tax implications of investing in mutual funds is crucial for investors to effectively manage their tax liabilities and optimize their investment returns. Mutual fund gains are subject to taxation, with taxes typically incurred on capital gains, dividends, and interest income generated by the fund's underlying securities. Capital gains taxes are levied on the profits realized from the sale of mutual fund shares held for more than 1 year, with long-term capital gains taxed at lower rates than short-term capital gains. Additionally, mutual funds may distribute dividends and interest income to investors, which are subject to taxation at the investor's ordinary income tax rate. Considering the tax implications of mutual fund investments is essential for investors to make informed investment decisions and minimize their tax burdens. By understanding how mutual fund gains are taxed and the potential impact on their investment returns, investors can implement tax-efficient investment strategies to maximize after-tax returns. For example, investors may opt for tax-efficient mutual funds that aim to minimize taxable distributions or utilize tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans to defer or eliminate taxes on investment gains. Moreover, investors should consider their investment time horizon tax bracket, and investment objectives when evaluating mutual fund options to ensure they align with their overall financial goals and tax planning strategies. By proactively managing tax implications, investors can enhance their after-tax investment returns and achieve long-term financial success. Addressing common myths and misconceptions about mutual funds is essential for investors to make well-informed decisions and navigate the financial markets effectively. One prevalent misconception is that mutual funds are only suitable for experienced investors or those with large investment portfolios. In reality, mutual funds cater to investors of all levels, offering a range of investment options tailored to different risk profiles and financial goals. Whether you're a novice investor looking to start small or a seasoned investor seeking diversification, there are mutual funds available to meet your needs. Another common myth surrounding mutual funds is that they are inherently risky investment vehicles. While it's true that all investments carry some degree of risk, mutual funds offer investors the opportunity to mitigate risk through diversification and professional management. By pooling funds from multiple investors and investing in a diversified portfolio of securities, mutual funds spread risk across different asset classes, sectors, and geographic regions. Additionally, mutual funds are managed by experienced professionals who conduct thorough research and analysis to make informed investment decisions on behalf of investors. By debunking these myths and clarifying misconceptions about mutual funds, investors can gain a better understanding of these investment vehicles and make confident investment decisions aligned with their financial goals and risk tolerance. In conclusion, we've embarked on a comprehensive exploration of mutual funds, uncovering their significance as a versatile investment tool for investors of all levels. Throughout this journey, we've learned about the structure and function of mutual funds, delved into their various types, and explored essential considerations such as fees, performance metrics, and tax implications. By understanding the benefits, risks, and myths associated with mutual funds, viewers are better equipped to make informed investment decisions that align with their financial goals and risk tolerance. As we wrap up, I encourage you, our viewers, to stay informed and remain proactive in your financial journey. By staying abreast of market trends, economic developments, and changes in investment landscapes, you can make educated financial choices that pave the way towards long-term financial success. Whether you're saving for retirement, funding your child's education, or building wealth for the future, mutual funds offer a flexible and accessible avenue for achieving your financial aspirations. Remember, knowledge is power. And by continuing to educate yourself and seek out reputable sources of information, you empower yourself to make informed financial decisions that support your financial well-being. Thank you for watching, and I hope you found this video informative and insightful. If you enjoyed the content, don't forget to like, subscribe, and leave your comments below. Your feedback is valuable, and I look forward to continuing this journey together as we explore the fascinating world of finance. Until next time, stay financially empowered.